I'd like to welcome you. Today is March 4th, 2026. My name is Cindy. I'm here at Russo Law Group. Thanks for joining us for a webinar entitled Key Tax Changes for 2025 and Beyond, What Every Family Should Know. Before we move forward, let's get started with some housekeeping items. This webinar will last 30 minutes. It will be recorded and a copy of the recording will be emailed to you. Please understand that your microphones will be muted for the remainder of the presentation. Feel free to chat amongst yourselves in the chat box and submit questions in the Q&A box. Vincent will address them at the end of the presentation. As always, we absolutely value your feedback, so please fill out and submit the survey that will be found at the last screen of this webinar. Now I'd like to introduce our presenter, Vincent J. Russo. He is the founder and managing partner here at the firm. He has over 40 years experience in practice of law and as an advocate for special needs people, the elderly and their families. He's a nationally noted speaker on the topic of elder law planning, estate planning, and special needs planning. He has co-authored the book, New York Elder Law and Special Needs Practice. He's a co-founder or founder of the National Academy of Elder Law Attorneys, the Academy of Special Needs Planners, the Elder Law section of the New York State Bar Association, and the Teresa Foundation. He's also a regular legal commentator on the Catholic Faith Network. Frankly, his achievements and qualifications are too vast to list on this screen, so I'm going to pass it over to him so he can continue.
Thank you, Cindy. Appreciate that. And welcome all to this program where we're going to focus on the key changes for 2025. And so it's going to be quick. We're going to highlight roughly 9 tax changes that everyone should be aware of that will impact your 2025 income tax return and going forward. And also we're going to touch on New York State and federal estate tax rules. We'll talk a little about the strategies to protect your assets and minimize tax liability. So here we go. We're right in tax season. First, we'll start with the permanent tax brackets and lowered rates. They now have been made permanent. That's all good news. So the rates will run from 10% to 37%, depending on where you fall with your taxable income. Also, we have a higher standard deduction for 2025. They have gone up roughly about $1,000 or so. So for single filers, that higher standard deduction will be $15,750. For head of household, $23,625, and for married couples, $31,500. So that's going to be a benefit for those who do not itemize, that they'll be able to take advantage of the higher standard deduction. Let's move on to a new deduction, the senior bonus deduction. Good news for seniors. Individuals 65 and older will be able to take a $6,000 deduction on their income tax return. If they're married, 65 and older, $12,000. And so the good news is this is an above the line kind of item where the extra deduction will lower your taxable income for determining perhaps the tax on your Social Security benefits. And so that's a real nice bonus. At the same time, though, there's an income phase-out rule. So we're going to talk about 2 things today on several of these tax changes. We're going to talk about income phase-out rules, and we're going to talk about how the provision may be temporary. So for the senior bonus deduction, the phase-out will occur if you're single. It starts to phase out once your MAGI, your MAGI, that's your modified adjusted gross income, is above $75,000. And it will fully phase out at $175,000. So as individuals have higher levels of income, they may see this senior bonus deduction reduced or phased out. If they're married, then the phase out starts at $150,000 and would be fully phased out at $250,000. So it's a change that's going to help those with income under the MAGI, the modified adjusted gross income levels, and those who are above that fall in the phase out provision. Tips. This is a big deal. Individuals can deduct up to $25,000 of their reported cash tips. And so you'll hear the term no tax on tips under the One Big Beautiful Bill Act. Now, who can take advantage of that? The occupation must be customarily and regularly receiving tips before 2025. So, for example, servers, bartenders, hairstylists, drivers, those are the individuals who are going to be able to accept cash tips and be able to deduct up to $25,000. Now, here again, we have an income phase-out rule. Deduction phases out and disappears for income over $150,000 for single individuals and $300,000 for married couples. Let's talk a little more about the types of tips. It applies to reported cash, credit card, and electronic tips. Non-cash tips are not able to be deducted under this new provision. The filing is above the line, so that's another positive step. Lastly, you may hear that it's no tax on tips, and that's true for income tax purposes, but not all taxes are excluded. So there will be Social Security, Medicare, state and local taxes applied to these tips. So in summary, for 2025, you get a federal income tax break on up to $25,000 in reported tips if you're in an eligible job and meet the income requirements. Phase out. We talked about it. I had mentioned temporary. So this provision is in the law for tax years 2025 to 2028. And then we'll just have to see what Congress does when we get around to 2029. Also, the other big change was to deal with overtime pay. So now there's a new deduction of up to $12,500 for a single person or $25,000 joint. The deduction applies to the premium portion of the overtime. So an individual gets time and a half. It's the half portion, the premium portion, that's not subject to tax. So for example, if someone was being paid $20 an hour, and then with overtime, they're being paid $30 an hour, $10 would be eligible for the deduction. And that's that overtime or premium portion. Here again, there's a phase-out rule, and there's a phase-out which starts decreasing the deduction when you have modified adjusted gross income over $150,000 for a single person, $300,000 for a joint, and then it disappears when the income for a single person, the modified adjusted gross income, the MAGI, is $275,000. And for a joint person, $500,000. For a joint, $550,000. Let's not forget that extra $50,000 if it's a joint return. All right, temporary again for tax years 2025 to 2028. Not all taxes are excluded, just like the tips. So there'll still be withholdings on FICA, Social Security, and Medicare. And so that you need to be mindful of this when filing your return. Let's move on to the child tax credit. This credit supports families with children. The credit amount for 2025 is $2,200 per qualifying child. And if it results in your having a refund, then the refund amount can be up to $1,700. All right. So it's $2,200 per qualifying child. That's the maximum credit. The child must have a valid Social Security number. And for the taxpayer, at least one parent filer on a joint return must have a valid Social Security number in order to qualify for this. What are the child requirements? Who is a child that you can get a credit on? A child is an individual under age 17 at the end of 2025. Relationships, it can be a son, daughter, stepchild, foster child. But this is interesting. It can also be a sibling or a grandchild. That child needs to live with you for more than half the year, and you have to provide more than half of their financial support. And lastly, they must be a U.S. citizen, natural, or resident alien with a valid Social Security number. So we got to follow the requirements there, but this will be of tremendous help to those families that have children, and even when a grandparent is taking care of a grandchild. Interesting. Let's go on to the SALT deduction. State and local taxes. This is a big deal for us here in New York, and for those who are in states that have an income tax law. We unfortunately have suffered through the loss of our state and local tax deduction. That would be income taxes, real estate taxes, for example, where it became capped. Used to be unlimited, then there was a $10,000 cap. Thankfully, the cap has been increased to $40,000. So that's good news. It's a situation where that 40 applies to a single filer or a married couple filing. And if you file and you're married separate and filing separately, then it reduces to 20,000. There is a phase out here again. And so the deduction begins to decrease for those with a modified adjusted gross income over $500,000. So that's a pretty high level. If your modified adjusted gross income is over $500,000, then the cap is gradually reduced by 30% until it reaches back down to the $10,000. All right. Also, as an aside, the mortgage interest deduction limit is now permanent. And so that's a nice change as well. Temporary, got to bring it up again. Here, the temporary means the SALT deduction increase cap of $40,000 is for tax years 2025 through 2029. We now have a new car loan interest deduction provision. It's a deduction for interest paid up to $10,000 for all U.S. assembled vehicles. The vehicle must be purchased and the loan taken after 12/31/2024. It has to be for personal use, not business use. The vehicle has to have final assembly in the United States. It has to be a secured auto loan. Leases don't qualify. And we again have the income phase out provision. So deductions phases out for Magi over $100,000 for a single person, $200,000 for joint, and fully phased out $150,000 for a single person and a $250,000 for the joint return. And it's temporary for tax years 2025 to 2028. Let me just highlight what's not covered. Used cars, interest on loans for used vehicles don't count. Leases, as I mentioned, are not deductible. And this EV credits, this new deduction is separate from and replaces the federal EV tax credits for U.S. assembled vehicles after September 30, 2025. So there's a lot to absorb when it comes to these income tax changes, because there are the phase outs, there are the temporary timeframes when these deductions will be available, and then there are more technical rules under each of these items. Now I want to shift to the federal estate tax laws. For individuals prior to 2025, if they passed away, there was a federal estate tax exemption of $13,990,000, a dramatic increase in the exemption levels over the last handful of years. And now it's been elevated to $15 million. So we have a $15 million exemption. Someone passes away with less than 15 million, there's no federal estate taxes. Also, I can mention that if they were to gift assets during lifetime, that exemption is both applies to estates and gifts cumulatively. So an individual could literally give away $15 million of, if that's the size of their estate, while they're alive, and there would be a gift tax offset by the exemption and no gift tax. Or if they passed away with the 15 million, there would be no federal estate tax. Now, once you're over the $15 million mark, then there's a federal tax rate kicking in at 40%. So anyone with a taxable estate of over 15 million definitely wants to meet with an experienced tax advisor who can help with reducing or eliminating the federal estate tax, allowing you to pass on your estate more fully or completely to loved ones. Also, at the federal level, we continue to have spousal portability. This means that if you're married and one spouse passes away, any unused portion of their federal exemption can be carried over to the surviving spouse. Now, there are some technical rules that have to be followed, including the filing of a federal estate tax return, electing the portability. And so here again, with proper planning, a married couple could have up to $30 million without a federal estate tax. But there could be millions of dollars of taxes incurred if the planning and the necessary portability election is not taken advantage of. Let's move on to the New York State side. There are a handful of states around the country that have either an estate tax or an inheritance tax. The majority of states do not have either, which is good news, such as Florida, for example. But here in New York, we do have an estate tax law. It does kick in once your exemption amount is exceeded, and the exemption amount has increased in 2026 to $7,350,000. Once you're over, then you're going to be subject to a New York State estate tax. And the estate tax rate, max rate, is 16%. So now someone might have a exempt estate from federal estate tax. Let's say they have $15 million, but they still would be incurring a New York State tax if they resided in New York, because their exemption is at $7,350,000. We also have what I'll call the dreaded New York State estate tax cliff, and it is brutal. that once you are over the exemption amount by 105%, then you lose your exemption completely. So taxes could literally be hundreds of thousands of dollars additional if you fall within this exemption of $7,350,000 above that exemption amount. There are some strategies that one can take advantage of to minimize the tax. And so there's a formula that applies to the calculation of the tax. It's complicated, but one literally could have a tax once you're over that exemption level where the tax rate literally kicks in. We had a computer glitch here, and hopefully you're all still on and can hear me. And so I want to just go over again the New York estate tax changes. So there's the exemption amount. It was prior to this year $7,350,000. It was less than. I'm sorry. Let me start again. I got to share my screen. Okay, we're back again. Sorry for these glitches. So the New York State estate tax exemption for 2026 is going to be $7,350,000, which is an increased amount. That's good news. Once you are over that amount, you're going to be subject to a New York estate tax. The maximum rate is 16%. So that's a significant amount. Unfortunately, in New York, we have what's called the dreaded New York State estate tax cliff. That cliff says that once you're over 105% of the $7,350,000, the exemption is completely taken away, and you're subjected to tax on the very first dollar of your estate. So that can be really nasty. And what's interesting is that if you're over the exemption amount by a relatively small amount, the actual tax on that extra money can be well beyond 16%. New York State has this complicated formula that can cause a significant amount of tax. So let me just give you a quick example. If you had an estate of $7,400,000 and the exemption was $7,350,000, you're over by $50,000, but the tax could be $136,643. It's crazy. Now, what's a strategy to reduce that tax or eliminate it? It's by including in your estate plan what's called a Santa Claus provision. I didn't come up with that. That's the name of it. And the Santa Claus provision says, well, if I'm over the exemption, I'll leave the extra dollars over the exemption to a charity, which then qualifies for a charitable deduction, which then zeroes out the tax. So it would be less money to give money to a charity and eliminate the estate tax, which then allows the family to inherit additional dollars. So in my example of $7,400,000, if 50,000 went to the charity, it would zero out the tax, eliminating the $136,643 in taxes. So the family ends up net ahead by $86,643, and you've helped a charity. I mean, what could be better than that? So people who fall within that kind of a band of an estate being over the $7,350,000 up to a certain point can take advantage of the Santa Claus type provision. Also, unfortunately, there's no spousal portability, which means that I can't double the $7,350,000 and say I've got $14,700,000 that is in my estate as a married couple and there won't be any tax. There needs to be planning because if you don't use the exemption, you lose the exemption, unlike the federal that has portability. All right, so we've highlighted these changes for you. And so let's just kind of do a quick summary here. Number one, take advantage of the new deductions and credits. 2, understand the impact on you. And 3, consult with a tax professional. The life is getting even more complicated than we think it could be. And these changes are nuanced. These changes, you want to take advantage of them, but you got to make sure you qualify for them. And so thank you for taking the time today. And again, I apologize for the glitches. Let's see if there are any questions in the dashboard. I don't see any at the moment. If you've given us a question and put it in the Q&A, we'll make sure we reach out to you. I appreciate all of you taking the time today to be on today's program. Just a little bit about the Russo Law Group. We've been in existence since 1985. We have 3 locations out here on the island: Garden City, Islandia, and Lido Beach. I have 5 partners. We're a team in terms of working together, making sure we maximize all our experience and knowledge for you. We've in the past have served over 17,000 families, and we have been recognized in numerous places with best law firm accolades. We'll also keep you informed of any upcoming events in the future. Go to our website. We've got lots of great resources on the website. We have guides that you can download, and the practice areas are all outlined with information on the website, from estate planning and elder law special needs, guardianship, trust and estates, Medicaid, small business, and real estate. With that, Cindy will jump in here to close today's program.
Vincent, actually, we have some questions in the chat. If you want to look, they're just coming in now.
Okay. So why don't you discuss social media and I'll read the questions in the chat.
Got it. Thanks so much for attending. Vincent's going to address your questions shortly, but I would love to invite you guys to join us on our accounts on social media. We have an Instagram, a LinkedIn, a Facebook, and a TikTok where you can find tons of informational content, such as our Fact Friday series, what's coming up next, and also past webinars and past In the Legal Know segments.
Okay, a couple quick answers here. One, people have notified me about the glitch that happened, so I think we rectified that. How to find a tax professional. We're always happy to be a resource if you want to contact us, our office, and we can give you some suggestions there. The senior bonus deduction. If you're married, both to get $12,000, both would need to qualify 65 or older. If only one, then it's a $6,000 amount. And is assisted living a medical expense deduction? Our position is yes, that would qualify as a medical expense and then be subject to the provisions allowing for a deduction as an itemized item. So thank you all again. Don't hesitate to contact Cindy and our firm with any questions that you have. Anyone interested in a meeting with us, we're happy to get together, and visit our website as a resource for more information. Have a great day and good luck with your taxes.
Have a good day.